Greetings. We are back with the third quarter end Pure Portfolio's video market commentary. I'm really excited for this edition. There's a lot going on out there. The looming government shutdown, cracks in the AI narrative, talks of a recession, the Fed cutting rates when markets are at all-time highs. Just a really interesting, compelling setup. And we've got some great graphs to share. Many of you will get this on October 4th or 5th. There could be a government shutdown, and we went back and looked at every government shutdown since 1976. And there has been 20 shutdowns, and the average S&P return during those shutdowns is about negative 0.4%, so less than a half of 1%, which is well in the normal range of normal trading. So I've said this to a few clients. Shutdowns are more of a nothing burger. The market has very low expectations of Congress, meaning they assume incompetence and divisiveness and back and forth. So this is really a shrug, and markets will move on rather quickly, regardless of what happens. Even the longer shutdowns, when we look back at history, have had a minimal market impact. And many times the market is actually up because it's less worse than markets expect. As you can see, party like it's 1999. The theme of this commentary, we are going to compare the setup now in technology stocks versus what it was back in 1999. There's been a lot of comparisons to the tech bubble and what's happening in AI today. There's some similarities, there's some differences, and we'll get into all of that. Let's get into the slides. As usual, we look at asset classes that are relevant to our clients. Starting here at the bottom, that's VBR in the lime green. That's small cap. Small cap had a pretty good rally last month, kind of lost steam this month, but flat. VNQ, this blue box, that is real estate, publicly traded REITs. Think data centers, think cell phone towers, think storage units. These are modern REITs, up a little bit. Purple, that's a snapshot of the U.S. bond market, up about 1%. Bonds are quietly having a pretty darn good year. There's income. They've tracked their current starting yields. Many bond ETFs in which we track are up anywhere from 4 to 7%. And again, they're paying a nice yield between 3 and 5%. SCHF, that's a international developed index. Think Greater Europe, Australia, Canada. Again, having a solid year. I believe this ETF, this equity asset class, is up almost 30% this year. IBIT, that's Bitcoin. Bitcoin's had a pretty good run this year, up another 2% this month. Again, the institutional adoption, the demand and supply imbalance, meaning a lot of demand, fixed supply, price goes up. The S&P 500 up 2.52%. The AI trade is kind of caught a tailwind at its back the last few months, but still the U.S. markets are one of the worst performing global markets despite the recent rally, and a lot of that was due, in our opinion, how stretched U.S. large caps were coming into the year, and then you had the tariff disruption and all of that. SCHE, emerging markets, quietly having a really good year as well, fueled by China and India. Again, that was a valuation story. China was dirt cheap heading into the year and is one of the areas in which we liked, and that is up 5.21% on the month. And then gold. Gold is something we've been talking about, we've been writing about, we've really liked. Again, what's not going to change in the next 10 years? Currency debasement. The US dollar has lost 20% of its purchasing power the last 5 years. Perpetual deficits. Gold, Bitcoin have a lot in common. I think their price action reflects what we've been saying, that those two asset classes should be part of a modern investment portfolio because these deficits, reckless spending, is probably not going away. Okay, we talk about AI a lot. We talk about the Mag 7 companies a lot, and this is why. As of 9/25, these top 10 holdings in the S&P 500 are about 40% of the index. And you can see that here, what it looks like, the top 10 holding weighting since 1980, year by year. And you can see the previous high was about 30% right after COVID. Now we're up to about 40%. And when you have such a top-heavy concentration, your margin for error is much smaller because the future prospects of the index really lie in a handful of companies. So it's very top heavy. And JP Morgan came out with a note, and I'm going to read it. 75% of the S&P returns since ChatGPT launched in November of 2022 have come from a small subset of companies. 80% of the earnings growth during that same period, again, driven by a small subset of companies. 90% of capital expenditures have come from this small subset of companies. Data centers are now eclipsing construction spending. Electricity prices have really skyrocketed, and a lot of that is driven by data center demand. So the concentration, earnings growth, a lot of S&P performance, capital expenditures, all influenced heavily by these top 10 companies. So a lot is riding on this AI trade. This is something I pointed out a long time ago, 8 to 9 months ago, that the question that matters is, will the AI trade pay off? We're investing hundreds and hundreds of billions of dollars every year. And right now the payoff is elusive. So this is something that we'll show you here in a minute. The revenue and the capital expenditures dynamic that's currently going on is unsustainable. And that's a good segue into this chart. This is construction spending going back to 2014 through September of 2025. And you can see, obviously, office buildings post-pandemic have seen a drastic decrease in new office buildings, which I think makes sense. But look at the data center. It's really taken the baton of office buildings and seen a large spike, which is directly correlated to electric power costs. So you can see as data centers go up, this kind of gold colored bar or line, electric power almost follows it 1-to-1, which does flow through to the consumer, which does flow through to inflation. So this is something to watch. The stress on our antiquated grid. These data centers take a long time to build. The run rate is quite long, and AI is a capital intensive, energy intensive endeavor. So it'll be interesting to see how this develops. This also will cost over time trillions of dollars. And again, we haven't quite seen the payoff for such a large, mind-numbing amount of capital expenditure. This is a good segue. So this was from GQG Partners, and they laid out a really good white paper about how AI is stretched and it's unsustainable, and we could be vulnerable. Back to those top 10 stocks that are driving a lot of this. They're making the case that we're quite frothy and due for a correction. But this is what we've been talking about for 9 months, that some of these popular language models are still not profitable, and their revenues leave a lot to be desired. So OpenAI, Anthropic are two of the largest, most developed language models. And then there's this light blue, which is other. So that's like Google and Microsoft and some of these other fringe models. But combined, AI revenues for these leaders, these early leaders, is still below $20 billion. Okay? It's projected that a lot of these AI players are going to need to spend $7 trillion by 2030 just in data centers and in advanced chips. And you can see the problem with that. Less than 20 billion in revenue, 7 trillion investment. That just doesn't compute. So something needs to happen. And the fear is a lot of this capital expenditure, these mind-blowing numbers, are going to end up in a capital destruction type environment, meaning there's not going to be a payoff. A lot of this stuff is going to go to waste. Some people compare it to Meta's investment in the metaverse, which flushed billions down the toilet. If that's the case, these stocks are really going to correct, and it's not going to be a slow unwind. It's going to be very quick, sudden, and violent, which is why we say, hey, we want to own AI. We want to be exposed to US large cap. We just want to be mindful of how exposed we are. I've said this before. We see a lot of prospective client portfolios, and I would say 9 out of 10 are way over allocated to US large cap, way over allocated to tech. And it's fine to take known risks, but a lot of these folks are just piling into the best performing corners of the market without knowledge of the range of potential outcomes. So this is something that we hammer on. And when you're over allocated to something, that means you're under allocated to perhaps more attractive asset classes, which is something that we've talked about too. Pretty much every other equity asset class besides US large cap, in our opinion, has a better setup from a risk return standpoint going forward. Okay, let's look at CapEx. And as I alluded to, a lot of these companies are spending a huge percentage of their earnings on capital expenditures. And the question is, will there be a payoff? So again, GQG Partners, which published a great white paper on this, goes back and looks at the energy CapEx bubble in mid 2014, 2015, and the telecom bubble at the end of the 1990s. Very similar levels of CapEx, and these orange bars did not turn out well. So what happened was these companies were investing in these capital-intensive projects. There turned out to be an oversupply, overcapacity in the build-out for a lot of this infrastructure, and there wasn't a payoff, and it was a bubble, and these stocks violently unwound. And you can argue that they haven't quite recovered yet. So in our last commentary, we talked about how the 10 largest companies often change through time. So the leaders in a certain decade are often not the leaders in the next decade. And some say a similar setup is happening now where there's an overinvestment in AI. The payoff is not in sight, and there could be a great unwinding. A lot of media outlets, a lot of smart investors are starting to cover this, that the AI boom is unsustainable unless tech spending goes to the moon. Some have argued that it's already done that. But many banks out there, many smart hedge fund managers out there are starting to trim their positions in US large cap, trim their positions in big tech because they think the current CapEx cycle is unsustainable. Let's look at the comparison between 1999 and the biggest weights in the S&P 500, which is in this left column. So this is as of December 1999, weighting in the S&P 500 by the biggest 10 companies. You can see a lot of these names are familiar. A lot of these names have gone the way of the dodo bird. And then today, so this is as of September 2025, weighting in the S&P 500. And there's also NTM is next 12 months PE, next 12 months price to earnings. So the larger this number here under NTM PE means the more expensive that stock is. So the higher number, the more expensive. And here is the weighting in the S&P 500 and the same set of information currently. So a few things stick out. The first thing is in 1999, the top 10 names were more expensive, trading 41 times next 12 months earnings. You can see while expensive, currently we're only trading at 31 times next 12 months earnings. So this is quite expensive. This is probably just expensive. And then the other thing is the top 10 names make up, call it 13 to 15%. The top 10 names currently, as we saw in a previous slide, are closer to 35, 40%. So much more concentration today. However, we're slightly cheaper on an aggregate of the 10 biggest companies in the S&P 500 versus 1999. But still, you can see there are outliers. Tesla, 151 times next 12-month earnings, meaning a lot of investors are expecting big things from Tesla based on how it's trading today. And there's some cheaper names. Google comes to mind, 22 times next 12-month earnings. You can see AT&T was 22 times, but the rest of these, some of these numbers are quite big. So not quite as expensive, but much more concentration today. Let's pivot to gold. Enough about AI. We've been writing about gold as well as a theme that we don't think is going to change with currency debasement, reckless spending, and deficits. You can see central banks have been buying gold hand over fist really since 2011, but it's accelerated post-pandemic. So net purchases, the light blue, anything light blue above this zero bound means a net purchase from a central bank. What's a central bank? The Fed is a central bank. The European Union central bank. So often central banks look to buy safe and sound currencies to put on their balance sheet. Now, we won't get into the weeds, but more often, again, post-COVID, instead of buying treasuries, instead of buying dollar-denominated assets or fiat currencies, paper currency assets, folks are buying gold and they're buying Bitcoin. They're buying assets that exhibit sound money principles. What's sound money? It means you can't create more supply. You can't artificially create more supply. So a fixed supply, higher demand, that's why you've seen the price of gold, the price of Bitcoin go up. And again, it's really accelerated over the past couple years. This is a theme that's probably not going to change. If you sit left, if you sit right, if you sit center, from a political standpoint, we can all agree that the government, and it's not just the US government, is probably not going to get their act together as far as spending goes and deficits go. Hence, you want to own assets like gold, like Bitcoin, that exhibit sound money principles, that keep pace with inflation, maintain their purchasing power. You know, the other two that we've covered are real estate and stocks. And then this is the dynamic currently happening. I know there's been a lot of talk about how foreign investors, foreign governments are shunning U.S. assets, shunning U.S. dollars and treasuries. That's not necessarily the case, but it's starting to shift. When the stuff hits the fan, foreign investors, domestic investors still want to own U.S. assets. You know, I think that shows up in the performance of U.S. treasuries this year, you know, especially in April when markets were going nuts. So these lines are the share of total official reserve assets. So think back to central banks, what central banks, global central banks hold on their balance sheet. And this dark line is gold. The teal line is U.S. treasuries. And you can see since 2000, gold's been pretty steady. Again, this darker line, and it's shot up post-COVID, meaning more central banks are buying gold. That's supported by the last chart that we saw. And you can see the U.S. Treasury percent of total official reserve assets has been pretty steady since the year 2000. However, it started to go down post-COVID. And post-COVID, there was an explosion of U.S. debt, of money supply, inflation raged. The dollar's lost, again, 20% of its purchasing power. So foreign investors, smart institutional capital is starting to say, I don't want to own a paper currency that's lost 20% of its value over the past 5 years. I want to own a store of value, a solid asset that maintains its value. That's what you're seeing here. You can say the same for Bitcoin. I keep drawing a parallel between gold and Bitcoin. They are more similar than different in our opinion. And if you're curious on why, I've wrote several blogs about that. You can find at pureportfolios.com. And again, I think the price movement of both assets has been supported by that thesis. But long story short, when you go back and look at the percentage of U.S. Treasury securities as a percent of total official reserve assets, it's been quite steady over the past 25 years, although it's gone down post-COVID. And then gold, again, been steady over the past 25 years. Post-COVID, you've really seen a spike up in the percent of total official reserve assets. Okay, lastly, fourth quarter performance. You know, a lot of people are worried about the froth of the S&P 500. We've come too far too fast. The AI theme is overhyped. There's not going to be a payoff. Well, this is kind of the other side, where from a seasonality standpoint, the fourth quarter historically has been the strongest quarter on the calendar. So we go back, I think this is as of 1928. Yeah, 1928. 74% of the time, the fourth quarter is positive with an average percent gain of 2.9%. Again, you can't set your watch to this. This is just the average over the past 90-something years. And you can see the gap has widened over the past 30 years, where before 2000, fourth quarter looked a lot like the other quarters. But as of post-2000, the fourth quarter is really separated, and it's become the best performing quarter on the calendar. Again, this could hold true. It might not hold true. This year is not like any other year. It's more closely aligned with, I believe 1995 or 1996 or something like that. And we're not saying the fourth quarter of 2025 is going to end up like this, up 3%, or it's going to be positive. I think looking at history just provides a historical framework of the potential outcomes. So What's overvalued can stay overvalued by any metric. US large cap stocks are stretched. They certainly can stay that way. I think that valuation has proven to be a poor timing tool because US large cap stocks have been really stretched for 2.5 years. And you can even make the case they've been stretched for longer than that. So what's overvalued can stay overvalued. We tend to focus on what we can control. That's how much risk that we're taking, understanding what risk you're taking. It's fine to take known risks. What we found through our prospective client portfolios, people are taking unknown risks. And what ends up happening is they're taking these unknown risks, markets sell off, they panic sell because they didn't understand the range of potential outcomes, and then they're stuck in a really tough spot. So we tend to lead with risk management, understanding drawdown, understanding known risks. If you own a bunch of mutual funds across 3 different custodians and you have a Roth IRA, a taxable account, trusts accounts, and IRA, it's really hard to understand what you own and your risk exposures. So we have some really unique tools to help people understand where the landmines are in their portfolio and then optimize that going forward to dial in the risk return framework for the next difficult market. Good investing starts today. It doesn't start by panic selling or making a bunch of changes after markets sell off. So let us know if you have any questions, if you want to learn more about the way we quantitatively manage client portfolios, stripping out human emotion, managing drawdowns, and certainly our services extend beyond portfolio management. We've got an AI tax tool. We've got an estate planning partner. We've got some great planning software. So shoot us a note at insight@pureportfolios.com. Thanks for watching.